And yes, it is that serious. The mounting economic impact of the coronavirus has prompted new emergency actions by the Federal Reserve. Will they work? Or is the Fed's playbook, well, played out? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. As you probably know, on March 23rd, the Federal Reserve announced an all-out emergency plan, a plan designed to promote economic stability in the midst of this pandemic. On that same day, coronavirus fears sent the stock market plunging to its lowest level since before the 2016 presidential election. A day later, the market rebounded on hopes that the Fed's actions and a new relief plan, approved by Congress, will help an economy rapidly sinking into recession. Since the coronavirus outbreak, huge sectors of the economy have been forced to shut down, and unemployment claims have skyrocketed. So how bad will it get? How long will it last? And what role will the Fed and the government overall play in answering these questions? And most importantly, for you, members of the income generation, what impact might all of this have on your goals and your financial strategies? We'll examine those important questions and many others on today's show. And joining us today for this discussion will be our co-host, Jeff Small, Amazon best-selling author and brand ambassador for the Retirement Income Store. But first, let's take a look at really the overview of the Fed's emergency plan. As one news source put it, the Fed's coronavirus emergency plan basically boils down to one thing: pull all levers. In other words, Fed Chairman Jerome Powell and his team are clearly prepared to do anything and everything in their power to minimize the mounting economic damage of this pandemic. A week before the emergency plan was announced, the Fed had already slashed their benchmark interest rate to 0 back on March 15th. In a normal period of slowing growth and a creeping recession, that move alone might have been enough to improve things. But even before the coronavirus outbreak, these were not normal times. Here are some other major components of the coronavirus emergency plan. First, open-ended quantitative easing. No surprise there. QE, which involves the Fed purchasing bonds in hopes of artificially infusing the economy with liquidity, has become common practice today for central banks around the world, and it has been ever since the financial crisis in 2008. Only a week earlier, the Fed had set a limit of $700 billion on its bond buying programs, but that limit is now gone. We talk about QE infinity. The Fed is also expanding the scope of what it can purchase to include commercial mortgage-backed securities. In addition, 2 lending facilities, the primary market corporate credit and secondary market corporate credit, have been tapped to issue new bonds and loans and to provide liquidity for existing corporate bonds. The Fed is also bringing back the crisis-era term asset-backed securities loan facility, known as TALF, to support the flow of credit to consumers and businesses, to expand the money market and mutual fund liquidity facility, as well as the commercial paper credit facility, among other measures. Yes, it all sounds pretty confusing, but the overall goal of all this is pretty simple: to try to make it cheap for consumers and businesses to get loans, while at the same time hoping public health officials can get the coronavirus under control and Congress can provide the relief needed to avoid another Great Recession or even a depression. So now let's bring in Jeff Small, Amazon best-selling author of the book Turning Financial Planning Right Side Up, also brand ambassador for the Retirement Income Store and founder of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Wow, Jeff, it's been a week already, and what a difference a week makes, does it not?
Dave, I don't know about you, but my head's been spinning this week between the largest gains and the largest declines in the market. We are really living a corona roller coaster. But what do you think about all that Fed action? The Fed action is unreal, unprecedented, as we witness the global destructive demand for products and services and supply chains, as the whole globe is really being put on hold right now. But what do you really think, Dave, that the Fed stimulus is going to get us out of this mess? What are your thoughts?
Well, in the traditional sense, absolutely not. Lowering interest rates to zero in the Fed funds rates, it did very little back in 2008. It's not going to do anything now because, although we don't have fear of systemic financial failure now like we did in 2008, we're going to end up with a deeper actual recession, borderline depression, possibly even a depression than we had in 2008. And it's because people are afraid to spend. So they can give away free money, they can lower rates, short-term rates to zero, they can do quantitative easing to drive down long-term rates, but people aren't going to spend money. Just because you print money and flood the economy with it, if you're not comfortable, if you don't know when you're going to be able to go back to work or when you're going to be able to leave your home again, you're not going to spend that money. So I believe the biggest thing that
So really what
Go ahead.
Really what you're saying, Dave, what you're really saying then is that we really can't cure the problem unless we cure the public health. Isn't that what you're trying to say?
We have to cure the public health, or Congress needs to get involved. And later on the show, I want to talk with you about what's going on with Congress right now and the bill. But the reality is that they have to assure us that somehow, some way, people's jobs are going to be available when they come back, that they're not going to be hurt financially. Then people might feel comfortable spending. So this is something that's got to be done with legislation. The Fed alone cannot do this. In fact, I think what a lot of the stuff the Fed's doing is really just creating a bigger debt bubble for our country. The biggest thing I like that the Fed did, Jeff, one thing I like that they did was the fact that they're basically keeping the plumbing going amongst financial institutions to ensure we don't have another 2008. We don't have fear of systemic failure. That's the one thing that the Fed is doing that I believe they really should be doing right now.
Well, you're right, Dave, and I think, just to add on to what you're saying here, the Fed is really becoming the lender of last resort, but also the buyer of last resort here, and they don't, they're commercializing the Fed into a regular commercial bank. In addition to all of that. And that is a monumental task. I don't think we've ever done that before. We're witnessing we're becoming a Japanese model here, the Japification of our economy and our banking system. I mean, that's incredible. I can't believe we're living in these times, and you and I are having this conversation. It's unbelievable.
No, it absolutely is. And later in the show, I want to talk to you about your thoughts about do you think we'll go negative interest rates as I believe due to this? But basically, even the Fed coming in now saying that they're going to buy corporate bonds. That's unprecedented. There's been some talk in the past about even the Fed buying stocks to prop up the stock market. That's not something that they're talking about right now, but I wouldn't be surprised if we end up seeing that. In fact, one of our guests on this show just a couple weeks ago said that very well could happen in the future.
Well, you're exactly right, Dave. And we just saw the greatest assist in history to the credit markets that are related to bonds. The Fed literally stopped the bleeding in the municipal bond components and the corporate bond components and the bond-based ETF components because they started purchasing these things, which is the Japanification of our credit markets. And so, companies like Schwab and Vanguard and Fidelity just got a huge assist by stopping the bleeding in those assets. We've now see, great buys in the bond market now that the Fed has plugged a hole and the lack of liquidity there, and they provided some. So this is really unprecedented. I completely agree with you. So it is the greatest assist, but the public health is the biggest concern, as you said earlier.
It has to be, yeah. And, liquidity dried up in the stock market really quickly. That's why we essentially had a race in a 1 month period of time where the Dow dropped by 38%. Now, of course, it's rebounded a bit, but it's probably not over. That's a liquidity loss of huge proportions when in 1 month it drops by 38%. Well, we saw it in the bond market, right? The bond market is much bigger than the stock market. But even the bond market, there weren't a lot of buyers. So it wouldn't surprise me, like you say, if they start propping up the bond market, because as we know, that's the safer part of the market compared to the stock market. always has been, always will be. They want to prop that up first. And then we get much bigger sell-offs in the stock market. Who knows what's going to happen at this point?
Well, as we transition now, don't you think that there's great buys for investors that are looking for fixed income in the bond market, maybe even in the municipal market, because we still haven't recovered. We've just stopped the bleeding, so there's lots of things on sale. So if there are companies that we can find that will transition through this to the other side of this virus corona scenario, this new corona economy that we're in, as we go through this demand destruction and the revenue destruction, and we make it through that, for companies that are on the other side, there are good buys out there in the marketplace today. We should not be shying away from fixed income assets at this time, because they literally are on a fire sale.
And there's good buys for everything out there today. There's good buys for common stocks. There's good buys for fixed income. The thing that makes fixed income a little different, as you know, is that if you think the stock market's a good buy, or certain portions of stock market are a good buy because they're down X%, well, there's no guarantee it's not going to end up down 2X. And it could take a lot longer to get back, at least in the fixed income markets, because there's a par value, because there's an amount that ultimately needs to get paid back to investors, provided there's no default. Typically, you feel like that's a safety net. And at the end of the day, in 2008, that's why, although stocks and bonds all dropped in value, the bonds came back a lot quicker because of that safety net. The stock market took a lot longer to come back. And Jeff, we need to take a commercial break here, so let's leave it there for just this block. And you stay with us too. We have a lot more coming up right here. Jeff Small, David Scranton, right here on the Income Generation, coming up in a moment. We'll be right back.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and/or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
About the same time the Fed's emergency plan was being announced, the financial markets also got hopeful news with the announcement that lawmakers had reached a deal on a $2 trillion stimulus package to combat the effects of the coronavirus. The Senate passed that bill late Wednesday night. Now, I want to let you know that with our efforts here to promote social distancing, we actually cannot do the show live. So we're actually recording this a couple days earlier. And by the time you see it, it's possible that this bill actually has become a law. But this bill, as it stands as of this recording, includes $1,200 checks to be sent to many Americans. It also includes a $367 billion package for small businesses, a $50 billion package specifically for passenger airlines, $8 billion for cargo airlines, and $17 billion for firms that are deemed important to national security. On the day the stimulus package was announced, the Dow Jones Industrial Average posted its best day since 1933. All the major indices enjoyed big rebounds from the day before, which saw the stock market sink to a level that wiped out all the gains that had been made since the president's election in 2016. In recent weeks, we've talked about the possibility that the coronavirus crisis could keep the stock market whipsawing like this with 1,000-point swings for months on end. Or that it could be the tipping point that triggers a third major stock market correction, on par with the magnitude from those from 2000 to 2003, and again from 07 to 09, or even worse than those. Now that actions by the government have calmed the markets just a bit, the question becomes, what are the odds that the coronavirus will prove to be that major tipping point? Well, as I pointed out on another recent show, it does share several common characteristics with tipping points of the past, which to me at least increase the odds that this is in fact that third major correction that's beginning. I also pointed out that the market's extreme reaction to the crisis was, in the short term, an overreaction. Largely because the market was in the midst of a blow-off top rally and was already so overvalued, so that excess growth was really just foam, so to speak, on top, and was bound to be able to be blown off quite quickly. Now that it has blown off and the markets have banked their hopes on lawmakers and the Federal Reserve, the question becomes, what can we expect? Time to bring back in my good friend and co-host, Jeff Small. Jeff, so Goldman Sachs has gone on record as predicting that our second quarter GDP can drop by a whopping 24%. Doesn't that put us into a depression-like situation, not just a recession?
Well, that number is huge, Dave. We've never had a mandated government recession where they shut the country down or they shut pockets of the country down. Now the globe is shutting down. So the numbers are going to be really bad. 24% is a wild guess. It could be 50%. But what we do know is the pain is going to be really bad. It's going to be really bad. We had over 3 million people file for unemployment claims. On April 3rd, we get the new unemployment claims for March, and I expect probably a 5 to 6 million number because employers are laying off people by the droves. The stimulus is great, Dave, but ultimately we're going to need much more than $2 trillion. And with $350 billion being earmarked for small businesses, loans are predicated on them keeping their people for a 2-month bridge loan and not laying off folks. And that's somewhat unrealistic. I feel like the stimulus plan itself is somewhat unrealistic, and it's more of a feel-good or it's more of a cosmetic move. But there's really no filtering mechanisms on how they're going to be able to access all of the stimulus for all the folks that are designated. It's going to be a work in progress. And so we're going to see really ugly numbers. But, as you said earlier, you're exactly correct that this is going to, be the third correction. Now, when we look at what happened with the last type of stimulus that we had historically, if you go back to 2008, Dave, you're going to see that it took 5 months for the stock market to hit the lows. In October of 2008, we passed massive stimulus congressionally, fiscally, and through also through the Fed. It took 5 months before we hit that March 2009 low in the market. So what do you think is going to happen going forward? Do you think that the market's going to keep rising? Because we're only 23% below the peaks right now as far as this correction goes. Do you think the market's got a chance of coming back here? Or do you think we're going to have some more ripples, even with the stimulus in the markets today?
Well, the markets short-term did overcorrect to the downside. Nothing had changed economically, but the Dow ended up down 38% at its peak low just earlier in the week. And I guess there's no surprise because markets tend to be forward-looking and they don't know what they're looking at because we've never been through the pandemic like this. So they overreacted short-term. Now, traders are coming in, they're buying, they're trying to push things back up again. But I agree, even if this package goes through, and again, by the time this show is being aired, it might even be signed into law, maybe in a slightly different form from when it passed through the Senate. We don't know. But our income generation viewers are not going to go out and spend more money and stimulate the economy just because they have another $1,200 in their pocket. They're just not going to do it. And I know it's only for people under a certain income level, but even if somebody makes $25,000 or $30,000 a year as a single person, they're not going to start spending because there's another $1,200. They're simply not going to do this. And you're right. I think what they're doing to help businesses is going to be a logistical nightmare. I think a lot of smaller businesses aren't going to trust it. And that's going to be a problem. Perhaps the biggest thing that I heard is that they're propping up the airlines. They're starting to treat the airlines almost like a quasi-utility, as something that's transportation-based, that needs to be supported in some sort of way, some quasi-nationalization, if you will. And that, I think, is important because we do need to have airline transportation. The world has become dependent upon it these days, as you can argue 80 years ago they had become dependent upon having a vehicle.
Yeah, it's definitely the structure of it. I think was put together very quickly to make it look like there was some fiscal help there from the congressional level and from the Trump administration. But I don't know what 2 checks of $1,000 each are going to do very much for people, other than bridge them for a couple of months, to pay bills and things like that. The necessities of life is what they'll apply them for. But what do they do after that? Then what happens is the question. And that's when the numbers get worse, regardless of the stimulus. So ultimately, we're going to need much more stimulus to be able to combat the economic effects. And I think it's really just a Band-Aid on the economy. But I thought it was quite comical to see some of the progressives in the Senate actually complain about what was happening in terms of the stimulus, because this is really from the playbook of the progressives, where we really lift people up financially by giving them money. And so it's almost like the first phase of what I would call, I hate to say this term, Dave, helicopter money. I mean, You know what that is, right?
Sure. Explain to our viewers.
That's really what it is.
Make sure our viewers are with the tour on helicopter money. Go ahead.
Well, I mean, helicopter money is when the government just prints up money and gives it to the populace. There was Andrew Yang, one of the candidates on the presidential Democratic side, had a plan where he wanted to give every impoverished American $1,500 a month. And the numbers get to be astronomical, Dave, because if you gave everybody $1 trillion, $1 million, there's only millions in a trillion. So obviously we can't give people $1 million, but we have too many people to give money to. It doesn't work into the budget unless we just start printing up things. But that's kind of what the Fed is doing now.
Jeff, it almost sounds like what the millennials refer to as MMT, modern monetary theory, where you just keep printing money forever without ever looking back. And Jeff, just to think, and we were afraid of Bernie Sanders in the office, right? And we're going to end up with probably more debt due to this coronavirus. So we need to leave it there for now. Stay with us. We'll be right back with more coming up in just a moment on the income generation. We'll be right back. Did you know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And for a limited time, we're offering a 3-month trial subscription to the Retirement Income Store newsletter. Visit theretirementincomestore.com to learn more.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently some fixed income investments have actually outperformed stocks, but yet you're still waiting to act. Visit theretirementincomestore.com today to regain control of your retirement.
In the midst of all the stock market volatility triggered by the coronavirus, the bond market has also felt historic impacts. In a classic flight to quality, fearful investors fleeing the stock market flooded the bond market, at least the government bond market, causing Treasury yields across the yield curve to plunge to their lowest levels ever. At one point, rates on all U.S. Treasuries, ranging from 2 years to 30 years, fell below 1% for the first time ever in our history. In fact, that's the main reason the Fed was forced to lower short-term rates to zero to uninvert the yield curve. As we've discussed before on the show, an inverted yield curve is not only a classic warning sign of recession, but can also be a cause of a recession. Because when long-term rates is determined by the 10-year Treasury fall below short-term rates, banks and other lending institutions have no financial incentive to approve loans. And as we've discussed, the Fed's entire emergency plan is designed to stimulate spending and borrowing to help reverse the impact of all the revenue being lost during this pandemic. So toward that end, quantitative easing also seeks to drive long-term rates downward to encourage all this borrowing. But with the yield on the 10-year Treasury rate already below 1%, Can it go negative like the 10-year government bonds of other countries? And if so, will the Fed then be forced to lower short-term rates below zero, flipping the entire banking model we have in this country upside down? Fed Chairman Jerome Powell has said flatly that's not a strategy he feels to be appropriate for the U.S. Yet, several central banks across Europe and as well as Japan have already been forced to adopt negative interest rates. So it's really not entirely out of the question for us here in the U.S., especially now that we're dealing with an unprecedented crisis after a decade of quantitative easing abuse and overuse. And we'll talk more about that too coming up in just a bit. Jeff, so I mentioned earlier my concern about negative interest rates. I really do believe we're going to see that. Do you share that belief or do you think otherwise?
Dave, rates, I don't know if anybody's paying attention, but the 30-day Treasury is at negative 0.11 right now. The 90-day Treasury is at negative 0.04 right now. So the curve naturally is starting to revert negative with all of the stimulus that we have going on. The short-term curve is. And so, you know, that's the trend. I mean, if the Fed goes negative, I mean, what are the benefits of going negative other than forcing people to take their cash and put it in play, invest it, put it in a business, as opposed, that's really another form of artificial stimulus or artificial manipulation. And it really is the end of the expansion of the economy when you create negative rates. And Europe and Japan are the perfect models to look at for that.
Well,
don't
especially
you think?
The Japanese model, they've been doing it now for over 2 decades. So here's how I see the ball bouncing or the dominoes falling, if you will, and tell me if you agree. Okay, just like we said before, though, people aren't going to spend money just because they get a check for $1,200 from the federal government. Well, similarly, they're not going to spend money just because they can go borrow interest rate. You can borrow money at lower interest rates right now. I've leased a vehicle for the first time in 25 years simply because I wasn't sure I wanted to keep it, and my payments are $600 a month. I'm getting calls now a year before my lease is up from the dealership saying I could lease a brand new version of the same vehicle for $300 a month, for literally half the price, which is absolutely amazing. But I'm not going to do it because I don't want to commit to that right now. So even if you do push down lending rates, people aren't going to go out and borrow money and spend, which is where the Fed may have to go negative. Once the demand starts to come up and people want to borrow, the next problem is then going to be banks are going to be tougher on credit because of what we've just been through. They're afraid, they want to make sure that people aren't going to default on loans. So that's why I believe the next move is the Fed will have to go negative on the federal funds rate to eventually tell banks that, look, if you don't lend the money out, if you keep it with us, you're going to have to pay us interest. So it's really like forcing the banks ultimately to lend money to consumers and to businesses, but doing it with the stick, not with the carrot.
Well, you're right about that, but I think the example of your lease there is an example of what I call deflation, and we are going to have massive deflation in asset prices and a massive contraction. The FDIC has already basically put out a memorandum to all the regional and small community banks that they can relax their standards, that they're going to relax their own standards for scrutiny, which means, I don't know how banks deal with loans on restaurants and bars and businesses that are being victimized right now and cash flows virtually stopping. But they're going to have to do something, some special credit or something, give them a break, or there's going to be massive amounts of defaults and foreclosures. But getting through this new corona economy, I will call it, we're going to see massive deflation. And your lease example from going from 600 to 300 is poetic, because that's going to happen in every tangible piece of thing that we can purchase. So we're going to have deflation, which is worse than inflation, Dave. I mean, don't you think it's worse than inflation?
Of course, the Federal Reserve has been trying to really manage inflation, to keep inflation at about 2%, to get some growth in the economy. And of course, when you have deflation, it just means there's so little demand for goods and services. So it's kind of funny, Jeff, because of course right now, there's some small slivers of the market that are seeing inflation because there's lack of supply. Things like masks for medical professionals and other folks walking around town. Hand sanitizer, right? As we've joked about before in the show, toilet paper. Those are things right now where the demand outweighs the supply, so we're seeing an inflation spike in certain prices. But we're seeing deflation overall. In fact, we talk about oil prices even in this whole Saudi Arabia versus Russia, as I might call it, a urination contest, if you will. I don't know if I could say that on TV, but I just did. And the bottom line is that they say the prices are down in oil because of that, but really they're also down because of the forward-looking in the futures market prognosis of less demand for fuel, right? If people aren't going to be flying at the airlines, and if goods and services aren't going to be delivered, exactly.
You just said it. Less demand equals deflation, and our economy is falling off the cliff. And until we get the public health ready, and people, we're both in Florida. Everybody is, whether you were ordered to mitigate or not socially, everybody's doing it. We've closed our office down. We're doing everything by phone. My staff is bringing their lunch. They're not ordering lunch. And so, this is going to disconnect demand entirely, which is going to cause substantial deflation. And it can't be countered by what happens with the stimulus, the Fed, the Congress, whatever they do. Until we get this public health thing resolved, we are going to have massive amounts of deflation across the board. And we're going to see that in asset prices. Now in the markets, we see a dramatic repositioning in things that are getting ready for the new corona economy and how the economy is going to be affected and what companies will be able to survive and make it through this and even prosper as a result of this. And I think the report out today was there's going to be a huge demand and surge for computers because there's going to be a rotational shift of people working to home as opposed in the workplace. And we have to retool, so to speak, as one example, that there'll be some benefits.
Well, it's always funny you mention computers because, as you know, when you and I kind of went over a lot of different credits, a lot of bonds and a lot of preferreds and things like that, we wanted to make sure that if we had total economic stoppage, that all the companies we hold in our portfolios could go well into 2021 and be able to pay all their employees all their expenses. So they can't cut back on expenses at all. Then they still have a cash burn rate that's going to last them about a year. Because that was the most important thing in our analysis. One of the companies we looked at was actually a computer company. And although they didn't have very much in cash burn, about 3 or 4 months, we felt as though still it was a good holding to keep because we know that the demand will be affected positively, not negatively, by this virus. So we need to take another commercial break. Stay with us. We'll be back here coming up in just a moment on the income generation. You're listening and watching Jeff Small and David Scranton. We'll be right back.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently some fixed income investments have actually outperformed stocks, but yet you're still waiting to act. Visit theretirementincomeStore.com today to regain control of your retirement.
Last week, we discussed how, with the coronavirus crisis, the current climate of overall low interest rates has created challenges for income-based investors like you, investors whose portfolios rely heavily on bonds and bond-like instruments. We also explained why this is a time when a financial firm that specializes in actively managed income-based strategies can be absolutely invaluable. Why? Because account managers can seek out the highest yielding options and upgrade portfolios on a daily basis on behalf of their clients. Something that's really, really hard to do when prices are so high. I also noted that even when account values drop in an income-based portfolio, the loss is typically only a paper loss. Why? Because bonds and bond-like instruments continue to generate income at the same fixed dollar amount regardless of market conditions. And also, they have a par value. And that par value is the amount that issuer has to repay when the bond matures. There's no such thing in common stocks. So even though you don't get more income when bond values go up, the good news is you don't get less income either when bond values come down. And that's one important way that investing for income provides a level of protection that you simply don't get with a portfolio based heavily on stocks and mutual funds. In those cases, your loss, I don't consider to ever be a paper loss. In fact, some stock market-based advisors might say that, but I don't consider it to be that way. Why? Because it's really a real loss, because you don't have a par value, any given amount that they have to pay back at a time in the future. With all this in mind, some of you are no doubt still concerned about what all the current market turmoil could mean for your investments, particularly when it comes to two questions. Number one, what if we do see negative interest rates? And number two, what if this is the third major correction and the stock market bottoms out? Jeff, we talked about negative interest rates. How's that going to affect members of the income generation? Clearly, people who own corporate bonds and things like that, those may not be in negative territory just because treasuries are, but still, how's it going to affect them, and what can people do to protect themselves who need to generate income during retirement?
Oh, Dave, I love this topic. This is my favorite topic to discuss, especially over the airwaves, because it's really misunderstood. It's my favorite topic. So, before I answer that question, what do you think for your viewership, the best asset class to hold was during the Great Depression? It was corporate bonds. So if you have corporate bonds on companies that can transition through the recession/depression or the new corona economy, they're going to be strong companies with good balance sheets and good numbers, you're going to make money. You're going to get your interest no matter what. Bond value goes up, bond value goes down, the income is level. But ultimately, as we see vacillations in market values and things start to normalize, when we get through this health scare that we're going through now, the values of these things will buoy back up. And so it's, we don't really want to sell bonds that are quality based because the income is static, and that's what we need. If you're looking for income, the common stock market is not the place to be. But as we transition and rates go negative, as Dave's original question was, and rates go negative.
But how about dividend paying stocks? How about blue chip dividend paying stocks, Jeff? Why don't those work?
Well, because your dividend can be erased in one bad market day for the next couple of years based on the recent history that we've had in markets. And so you don't look for a bond proxy in common stocks if you need income, because you're going to eat your principal. You're going to end up eating your principal at some point, and it doesn't produce enough income. The average dividend rate on the S&P is 1.8%. That's not enough dividend. I mean, it's closer to,
And in 2008, a lot of corporations cut their dividend.
They did,
not?
and a lot of companies are getting rid of their dividends because they understand the demand destruction and revenue destruction that's going to occur. So we want to look for companies that can weather that storm in the fixed income arena.
And the good news now, as you well know, is if you went back more than a month ago, a lot of bonds that you'd be looking to buy in the secondary market were at a premium. And that means they're selling it above the par value, the repayment value. That means that someone might pay $110 to get a certain rate of interest, knowing that when the bond gets repaid, when it matures, they're going to get $100 back. So the interest had to be high enough to warrant taking that $10 loss. Well, now if you can buy the same bond for $90, your income as a percentage is a lot higher because your income is based upon the par value and you're paying less than par value. But also now you've got a great capital gain opportunity of 11% when that goes from 90 up to 100 at maturity, if not sooner. And it's a capital gain in a bond, which is much less risky than trying to go for capital gains.
Well, and that's what I alluded to.
As you're well aware.
That's what I alluded to.
And we're running out of time, Jeff, in this. But unfortunately, with us working remotely, you don't have the advantage that I do of having the producer in your ear. So we need to take another commercial break. Stay with us. We'll be back here with more coming up in just a bit on the income generation. We'll be right back. Welcome back to Income Generation. I'm here with our co-host, Jeff Small. Jeff, first of all, thanks so much. I know you're busy with the markets and turmoil and making sure you're keeping your clients happy, as we are. But thanks for taking the time to be Skyped in here with us today. Really appreciate it.
Well, thanks for having me today, Dave. You know, I love co-hosting the show with you. We have a lot of fun, but I really like getting out information to your viewership because I do get calls from random people across the country on what they should be doing with their portfolio because of this show. And so I think we need to summarize exactly what it is investors should be doing today in a big picture perspective without giving individual advice, of course. So what do you think we should be telling our investors today? And what should people that are focused on stocks that might need income, what should they be doing today?
I guess it depends upon your needs. So I'm going to talk to the income generation members, the members that are over the age of 50, part of the income generation, that are probably within 10, maybe even 15 years of retirement. Because, you know, from 2000 to 2013, we had 13 years where the stock market was underwater. Granted, to varying degrees, but it was underwater. So if you're part of the income generation, then you've got to be really careful how much you hold in common stocks right now. If you've already pared down your stock exposure to the level that you deem reasonable, then that's okay. That's good news. Now you get to look for opportunities in income-generating securities like the corporate bond market, like we talked about a moment ago. But if you're one of those who hung in there a little too long, who try to wring out the last few percentage points on this last cyclical bull market, now you've got to be really careful. So you got to sit down and think, okay, when do I want to retire? Do I have enough? What kind of return do I need in order to be able to hit my goals? And if you can hit your goals without swinging for the fences, then you should maybe take these little upticks like we've seen over the last few days and use that as an ability to pare down your risk and gradually start to transition into more income-based things. Because Jeff, if you and I are right and it's going to get worse before it gets better, you know, this isn't a time to be buying the dips, as a lot of the talking heads on television like to say. This is a time to be selling the peaks to gradually move people over from growth to income. In the last 45 seconds, do you concur? And if not, why?
No, I couldn't agree with you more. I think that the interest earnings from bond and bond-like instruments will outperform the market the next 5 or 10 years as we play the recovery game and transition through the corona economy, because the economic numbers are going to come back really bad. Employment, GDP, domestic, global, it's going to get really bad, Dave. And I think that's what people have to they should be glad today the market's buoying up a little bit from the recent volatility that we've had, but that's typical in this type of a cycle. And you nailed it when you said, yeah, this is a 20-year cycle, and every 20 years, 14 to 20 years, we've had 3 corrections, and now we're in the last one, as you predicted.
Stay with us. We'll be back here in just a moment, coming up again, right here on the Income Generation. We'll be right back. Welcome back to the show. First of all, Jeff, thank you so much for joining us again today on the show. I know you love doing this. You love talking to our Income Generation members. And unfortunately, it's not as fun this way as it is when we're sitting next to each other in studio. But thank you so much. It's been my pleasure having you back.
It was my pleasure to be here, Dave. Thank you.
It's a big job, and I can always use some help at times like this when we see unprecedented volatility in the markets. But most importantly, I want to thank you, our new and returning viewers. You know, as you might imagine, covering all the developments and the changes in the financial markets and the economy right now is, as I said, a major challenge. It's especially true with a weekly program like ours, since changes have been taking place almost by the hour since this crisis started. What makes it even more challenging is that some of the issues we're dealing with are unprecedented. The extreme levels of market volatility we've seen, the entire U.S. yield curve falling below 1% for the first time ever, and the potential long-term impacts, this massive global shutdown, really an economic stoppage, just to name a few. We're facing many new unknowns in this situation, which is why the Fed and lawmakers are taking drastic actions to address these issues. How effective will they be? When will American life and the U.S. economy return to normal, if ever? No one knows, of course, but in times of uncertainty, few things are more important than safety and precaution. Taking the right steps to protect your personal health and your financial health has probably never been more critical than it is right now. In terms of the latter, in my experience, that means seeking the help of an advisor who specializes in financial strategies that are geared toward portfolio protection and retirement income, which of course is easier than ever before, thanks to Jeff and my very own Retirement Income Store. Thank you for watching. If you're close to retirement and really want to know how to protect and maximize your money, yes, it's essential you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton with Jeff Small, and we'll see you next week.
The road to retirement is filled with twists and turns, and life's unexpected detours could easily throw you off course. That's why it's essential to work with a financial advisor who is also a fiduciary experienced in helping clients navigate the complexities of retirement planning while helping you pay yourself first. The road to retirement now made simple. To learn more, visit theretirementinComeStore.com.